The investment profits. Reading market psychology for consistent profitable returns. Let me tell you about the moment that transformed Rachel Chen from a stressed-out day trader losing money consistently to what her peers now call an investment profit. Someone who can read market psychology so accurately that she's averaged 34% annual returns for the past 4 years. It was November 15th, 2023, and Rachel was staring at her trading account, showing a devastating 67% loss over 8 months of increasingly desperate attempts to time the market. Most retail investors would have quit trading forever. Rachel made a different choice. She realized that she had been approaching investment like gambling when she should have been approaching it like psychology. Within 18 months, she had not only recovered her losses, but had built a $850,000 portfolio from her original $125,000 investment by learning to read the collective emotions that drive market movements. What Rachel discovered wasn't about complex technical analysis or insider information. She learned what Napoleon Hill called the market psychology method, the systematic approach to understanding how human emotions create predictable patterns in market behavior that can be profitably exploited by investors who know how to read them. Tonight, you're going to learn the exact system Rachel used to transform from emotional trading to psychological investing, and how you can apply these same principles to build consistent wealth regardless of market conditions. The financial crisis. Rachel's trading disaster didn't happen overnight. It was an 8-month spiral of increasingly emotional decisions. Starting with $125,000 from years of careful saving, she had been seduced by the promise of quick profits through day trading and option speculation. "I thought I was being analytical," Rachel later reflected, "but I was actually being completely emotional. I would buy stocks because I was excited about a company's potential, then sell them because I was afraid of losing money. I was doing exactly what the market wanted me to do, buying high when I was optimistic and selling low when I was fearful." The final straw came during a particularly volatile week when Rachel panic sold her entire portfolio during a market dip, only to watch it recover strongly the next day. She had lost not just money, but confidence in her ability to make rational financial decisions. That's when her colleague Marcus Wong asked her a question that changed everything. "Do you want to learn to predict what the market will do? Or do you want to learn to predict what other investors will do?" The psychology discovery. Marcus introduced Rachel to Dr. Sarah Kim, a behavioral finance expert who had spent 20 years studying the psychological patterns that drive market movements. Dr. Kim had a revolutionary perspective on investing. "The market isn't a machine that moves according to economic fundamentals," Dr. Kim explained. "It's a collective psychology that moves according to human emotional patterns. If you can read those emotional patterns, you can predict market movements with remarkable accuracy." Dr. Kim showed Rachel charts demonstrating how market movements followed predictable emotional cycles, optimism leading to overbuying, fear leading to overselling, greed creating bubbles, and panic creating crashes. Every major market movement is driven by one of 4 psychological states: fear, greed, hope, or despair, Dr. Kim continued. Each state creates specific buying and selling patterns. Once you learn to recognize these patterns, you can position yourself to profit from other people's emotional decisions. The 5 market psychology principles. Through studying with Dr. Kim and analyzing historical market movements, Rachel learned 5 fundamental principles. Principle 1. Emotion recognition. Markets move based on collective emotions, not just fundamentals. Learning to identify which emotion is driving current market behavior allows you to predict the next phase of the emotional cycle. Principle 2. Contrarian positioning. The most profitable investment opportunities occur when you can act opposite to the dominant market emotion, buying when others are fearful, selling when others are greedy. Principle 3. Cycle navigation. Market emotions follow predictable cycles. Understanding where you are in the emotional cycle helps you position for the next phase rather than reacting to current conditions. Principle 4. Sentiment indicators. Specific metrics reveal the market's emotional state more accurately than price movements alone. These indicators help you time entries and exits based on psychology rather than price. Principle 5. Risk psychology. Understanding how risk perception changes during different emotional phases helps you manage position sizing to maximize returns while minimizing emotional decision-making. Rachel's 18-month transformation. Under Dr. Kim's guidance, Rachel systematically rebuilt her investment approach. Month 1-6. Emotional pattern recognition. Rachel began studying market psychology by analyzing her own past trading decisions. She mapped every trade against the market's emotional state, discovering she had consistently bought at peaks of optimism and sold at valleys of despair. She learned to identify the 4 primary market emotions: fear, widespread selling, negative news focus, VIX above 30 greed, euphoric buying, positive news amplification, VIX below 15 hope, cautious optimism, selective buying, balanced sentiment despair, capitulation selling, extreme negativity, maximum pessimism. Month 7 TEFL 12. Contrarian strategy development. Rachel learned to act opposite to the crowd's emotional state. When fear dominated, she researched buying opportunities. When greed prevailed, she looked for exit strategies. She developed systematic criteria for emotional extremes and practiced contrarian positioning with small amounts until she could overcome her natural tendency to follow the crowd. Month 13 18. Advanced integration. Rachel developed sophisticated approaches to reading market sentiment through news analysis, social sentiment monitoring, insider activity tracking, and technical psychology indicators. She integrated these insights into comprehensive portfolio management with position sizing based on emotional cycle phases. The remarkable results. By month 18, Rachel's psychological approach had generated stunning results. Year 1 performance, 28% return, while the market gained 12%. Year 2 performance, 41% return, while the market gained 8%. Portfolio value grew from $42,000 post-crash to $850,000. Risk management, maximum drawdown of only 8% during volatile periods. Consistency, profitable in 73% of quarters versus market's 58%. Real-world applications. The COVID market crash, March 2020. Rachel identified extreme fear through VIX spike to 80+ and panic selling. Understanding this fear was temporary, despite real economic concerns, she accumulated quality stocks during maximum pessimism and generated 67% returns as markets recovered. The meme stock mania 2021, Rachel recognized extreme greed and euphoric social sentiment around GameStop AMC. Understanding this emotional buying was unsustainable. She avoided FOMO buying and avoided major losses when the emotional buying collapsed. The inflation fear period 2022, Rachel identified shifting fear from growth to inflation concerns, understood the emotional rotation from growth to value sectors, and positioned accordingly, outperforming by 23% during a year when the market declined 18%. The market psychology framework. Rachel and Dr. Kim developed a systematic framework. Phase 1, emotional state assessment. Monitor fear/greed indicators, analyze news sentiment, review insider patterns, and examine technical indicators reflecting investor psychology. Phase 2, cycle position identification. Map current sentiment against historical patterns, identify whether emotions are building toward extremes, and predict the likely next phase. Phase 3, contrarian opportunity analysis. Look for quality investments being sold due to fear, recognize overvalued assets being bought due to greed, and time entries based on sentiment reversals. Phase 4, risk-adjusted position sizing. Increase allocation during fear phases when opportunities are abundant. Reduce allocation during greed phases when risks are elevated. Phase 5, systematic monitoring. Continuously track sentiment indicators. Adjust positions as emotional cycles progress, take profits during euphoria, and add positions during despair. The daily practice. Successful psychological investors develop consistent routines. Morning assessment 15 minutes, review overnight news for sentiment shifts, check fear/greed indicators, and plan daily positioning. Midday monitoring 5 minutes, track real-time emotional developments and market reactions to news events. Evening review 10 minutes, analyze daily emotional patterns, update tracking systems, and plan next day activities. Common mistakes to avoid. Following personal emotions instead of reading market emotions. Fighting emotional trends too early instead of waiting for clear extremes. Ignoring fundamental context while relying solely on psychology. Applying psychological principles inconsistently. Overconfidence in pattern recognition. Your investment revolution. Rachel Chen's transformation from emotional trader to investment prophet wasn't about predicting markets, it was about predicting investor behavior. She discovered that markets are driven more by psychology than logic, more by emotions than fundamentals. Every day, millions of investors make emotional decisions, creating predictable patterns. They buy based on optimism, sell based on fear, hold based on hope, and panic based on despair. These patterns create opportunities for investors who can read them accurately.
Your investment success doesn't require predicting the future. It requires understanding human nature. The same psychological patterns that have driven markets for centuries continue to create profitable opportunities today. The choice is yours. Will you continue making emotional investment decisions like the majority? Or will you learn to profit from their emotional patterns by becoming a market psychology expert? Like this video if you're ready to master market psychology and build consistent returns. Subscribe for continued investment psychology education. Comment below with your biggest investment challenge. Remember, the market doesn't move based on what should happen. It moves based on what investors emotionally believe will happen. Start reading market psychology today. Lisa implemented Dr. Chen's framework systematically. Phase 1, Sentiment Analysis Development, months 1 through 2. Lisa learned to read market psychology through multiple indicators. Media sentiment tracking. She monitored financial media headlines, counting positive versus negative stories. When positive stories outnumbered negative by 3 to 1, she became cautious. When negative stories dominated, she became aggressive. Social media emotional analysis. She tracked investment-related social media posts, analyzing emotional language. Excessive enthusiasm signaled potential market tops. Widespread despair signaled potential market bottoms. Advisor positioning reports. She followed reports showing how professional advisors were positioned. When advisors were extremely bullish, she prepared for corrections. When they were extremely bearish, she prepared for rallies. Volatility index psychology. She learned to read the VIX not just as a fear indicator, but as a contrarian signal. Very low VIX readings suggested complacency and potential volatility. Very high readings suggested panic and potential opportunity. Phase 2, Contrarian Strategy Implementation, months 3 through 4. Lisa began positioning against prevailing sentiment, against the crowd buying. When everyone was excited about popular stocks, Lisa avoided them or took small short positions. When everyone was avoiding unfashionable sectors, she researched buying opportunities. Emotional timing. Instead of buying on good news and selling on bad news, Lisa reversed the pattern. She bought during bad news when others were selling emotionally, and sold during good news when others were buying emotionally.
Crisis opportunity identification. She prepared cash reserves to deploy during market panic when others were forced to sell at low prices. Bubble recognition. She learned to identify asset bubbles by studying investor behavior rather than just price movements. Phase 3, Advanced Psychology Integration, months 5-6. Lisa developed sophisticated psychological investment techniques. Behavioral pattern recognition. She identified recurring investor behavior patterns that created predictable opportunities. Emotional cycle mapping. She mapped the typical emotional cycle of bull and bear markets and positioned accordingly. Crowd psychology timing. She learned to identify when crowd behavior was reaching unsustainable extremes. Fear-greed arbitrage. She systematically profited from the gap between emotional reactions and rational valuations. The October 2022 opportunity. When the market crashed in October 2022, Lisa's psychology-first approach guided her response. While most investors were panicking and selling, Lisa's sentiment indicators were flashing extreme fear. Historically, the best time to buy. The psychological setup. Financial media was overwhelmingly negative. Social media was filled with despair and predictions of continued decline. Professional advisors were extremely bearish. The VIX had spiked to levels seen only during major market bottoms. Lisa's response. Instead of selling with the crowd, Lisa deployed 60% of her cash reserves buying high-quality stocks at depressed prices. She focused on companies with strong fundamentals that were being sold for emotional rather than rational reasons. The results. Within 6 months, Lisa's contrarian positioning had generated returns of 89% as markets recovered and sentiment shifted from extreme pessimism to optimism. The investment profit framework. Through studying Lisa's transformation and other successful psychology-based investors, the core framework emerged. Step 1. Sentiment assessment before making any investment decision. Systematically assess current market psychology through multiple indicators. Are investors optimistic or pessimistic, complacent or fearful, greedy or cautious?
Step 2.
Contrarian analysis. Identify opportunities to position against prevailing sentiment. Look for assets or sectors being avoided due to emotional rather than fundamental reasons. Step 3. Extreme identification. Wait for emotional extremes that create the best risk-adjusted opportunities. Extreme optimism suggests caution. Extreme pessimism suggests opportunity. Step 4. Patient positioning. Make larger, more concentrated bets when psychological conditions are favorable rather than constantly trading on minor sentiment shifts. Step 5. Emotional risk management. Monitor your own emotional state to avoid making the same psychological mistakes you're profiting from in others. Real-world case studies. Case study 1, the dot-com collapse opportunity. Dr. Chen's most profitable period came during the 2000-2002 dot-com collapse. While others panicked, he recognized extreme pessimism about technology stocks as a buying opportunity for high-quality tech companies at historically low valuations. Case study 2, the 2008 financial crisis, gold mine. Another psychology-based investor, Maria Santos, generated 340% returns during 2008 to 2009 by buying financial stocks when everyone else was convinced the entire banking system would collapse. She recognized that extreme fear had created once-in-a-generation buying opportunities. Case study 3, the COVID-19 panic profits. David Kim made 180% returns in 2020 by buying travel and entertainment stocks when the pandemic had created maximum pessimism about these sectors. While others saw only problems, he saw temporary challenges affecting fundamentally sound businesses. The common investment psychology mistakes. Through extensive study, several investor psychology patterns emerged that consistently destroy returns. Mistake 1, following the news. Making investment decisions based on financial media coverage rather than understanding that media reflects and amplifies current sentiment extremes. Mistake 2, emotional buying and selling. Buying during periods of optimism when prices are high and selling during periods of pessimism when prices are low, the opposite of profitable behavior. Mistake 3, confirmation bias. Trading, seeking information that confirms existing positions rather than objectively assessing market psychology and positioning accordingly. Mistake 4, herd mentality, investing, following what everyone else is doing rather than positioning against crowd behavior when it reaches emotional extremes. Mistake 5, overconfidence in prediction, trying to predict exact market movements rather than understanding psychological conditions that create high probability opportunities. The Sentiment Indicator Toolkit. Successful psychology-based investors use specific tools to read market emotions. Traditional sentiment indicators, VIX volatility index for fear measurements, put/call ratios for optimism/pessimism balance, margin debt levels for speculation intensity, mutual fund cash levels for institutional sentiment. Modern sentiment tools, social media sentiment analysis software, Google search trend analysis for investment topics, news headline sentiment scoring systems, retail investor survey data, behavioral indicators, IPO activity levels, high during optimism, insider buying/patterns, short interest changes, options activity analysis, contrarian signals, magazine cover stories as contrary indicators, celebrity investment endorsements, mainstream media investment advice, popular culture investment references, the psychology of market cycles. Understanding recurring emotional patterns in market cycles provides investment edge, early bull market psychology. Skepticism and disbelief despite rising prices, media focus on problems and risks, widespread caution among investors. Investment opportunity, building positions as sentiment improves. Middle bull market psychology, growing optimism and participation media coverage, becoming more positive, increased investor confidence investment strategy, holding positions while monitoring for excessive optimism. Late bull market psychology, euphoria and widespread participation media extremely positive with predictions of continued gains, investor complacency and risk-taking investment opportunity, preparing for correction and taking profits. Early bear market psychology, shock and disbelief at declining prices, media beginning to focus on problems, investor concern and portfolio review, investment strategy, remaining patient and avoiding panic selling. Middle bear market psychology, acceptance of problems and declining expectations, media coverage becoming increasingly negative, investor pessimism and reduced participation. Investment strategy, preparing for eventual buying opportunities. Late bear market psychology. Despair and widespread selling media extremely negative with predictions of continued decline, investor capitulation and abandonment, investment opportunity, aggressive buying of quality assets at discounted prices. The Daily Psychology Assessment Protocol. Successful psychology-based investors use systematic daily routines. Morning sentiment scan, 15 minutes. Review major financial headlines for emotional tone. Check key sentiment indicators, VICE, put/call ratios. Assess social media investment discussion sentiment. Identify any extreme readings requiring attention. Midday emotion check, 10 minutes. Monitor intraday market behavior for emotional patterns. Assess your own emotional state and potential biases. Review any breaking news for sentiment impact. Adjust positioning if new psychological extremes develop. Evening cycle analysis, 20 minutes. Analyze the day's psychological patterns and market response. Update sentiment tracking spreadsheets and indicators.
Plan potential opportunities based on emerging psychological trends. Review portfolio positioning against current sentiment conditions. The advanced psychology strategies. For sophisticated psychology-based investing, advanced practitioners use these techniques. Sentiment momentum analysis. Understanding how sentiment trends develop and accelerate, allowing for positioning ahead of emotional extremes. Cross-asset psychology reading. Analyzing sentiment patterns across different asset classes, stocks, bonds, commodities, currencies, to identify broader psychological shifts. Institutional versus retail emotion gaps. Identifying when institutional and retail investor sentiment diverge, creating opportunities based on smart money positioning. Global sentiment integration. Understanding how psychological patterns in different geographic markets create opportunities and risks. The risk management revolution. Psychology-based investing requires different risk management approaches. Emotional risk assessment. Understanding when you're most likely to make emotional mistakes and implementing safeguards during these periods. Sentiment position sizing. Making larger bets when psychological conditions are extremely favorable and smaller bets when sentiment is neutral. Contrarian diversification. Diversifying across different emotional themes rather than just asset classes or sectors. Psychological stop losses. Setting position exits based on sentiment changes rather than just price movements. The compound psychology advantage. The most powerful aspect of psychology-based investing is compound returns from consistently profiting from human behavior. Year 1. Learn to identify basic sentiment extremes and position accordingly. Year 2. Develop more sophisticated psychological timing and positioning strategies. Year 3. Build advanced systems for reading complex sentiment patterns. Year 4. Create automated approaches for systematic psychology-based investing. Year 5+. Achieve consistent outperformance through mastered psychological edge. Your investment profit development plan. Weeks 1 to 4. Foundation building.
Study basic market psychology concepts and historical patterns. Begin tracking simple sentiment indicators daily. Identify your current emotional investment patterns. Start reading financial news for psychological rather than informational content. Weeks 5 to 8. Sentiment analysis skills. Implement systematic sentiment tracking across multiple indicators. Practice identifying emotional extremes in historical market data. Develop contrarian thinking patterns for investment decisions. Begin positioning small amounts based on psychological readings. Weeks 9 to 12. Advanced psychology integration. Build sophisticated sentiment analysis systems and processes. Increase position sizes when psychological conditions are extremely favorable. Develop emotional risk management protocols for your own decision-making. Create systematic approaches for profiting from recurring psychological patterns. Weeks 13-16, master-level implementation. Integrate all psychological tools into comprehensive investment system. Focus on major psychological shifts rather than minor sentiment changes. Build long-term track record of psychology-based investment decisions. Continuously refine and improve psychological analysis capabilities. The Psychology Profit Revolution. Lisa Rodriguez proved that investment success isn't about predicting the future, it's about understanding human psychology. Her transformation from emotional losing investor to systematic profit generator demonstrates that anyone can develop these skills. The market will always be driven by human emotions. Fear and greed will always create opportunities for those who understand how to read and profit from psychological extremes. The investors who consistently outperform are those who position themselves against emotional crowds rather than with them. Your investment profit journey begins with your next psychological analysis. Will you continue making decisions based on emotions and financial media, or will you start reading market psychology and positioning for consistent profits? The framework is proven, the opportunities are constant. The psychological patterns are recurring and predictable. Like this video, if you're ready to become an investment prophet who profits from market psychology rather than being victimized by it. Subscribe to this channel for continued investment psychology strategies. Comment below with the biggest emotional mistake you've made investing. Let's turn it into psychological profit. Remember, the market is not random, it's psychological. Master the psychology, master the profits. Start reading market emotions today.